All right. Good morning. Good morning. How are you guys today? I want you to see my screen. I'm going to bring myself up here into the upper right-hand corner so we can show off a little bit down here. It's important for you to see what's going on right here. You can see that we're down 820 on yesterday's straddle on the put that we bought, and we also bought a long call. We're up 1723. As soon as the market opens, I'm going to liquidate that and take the profit. It's up $902. That's just a simple straddle is all it is. It was a 2-day straddle, and we put that on yesterday so that we could use it as insurance for our sold butterfly. All right. So we put a butterfly on yesterday, and we had an extended insurance policy, and the insurance policy is up $900 right now. But that's because of implied volatility. If we let that sit there and say, oh, I'm going to get rich, rich, rich beyond my wildest dreams by letting it run all day long, well, it probably won't be that high by the end of the day unless the market really takes off and runs. It may do that, but the reason it's so high right now, when we've learned this in the past, right, because we've done that, we've like, oh, let's let it hang out for a while and we'll see where it goes, is because the implied volatility is quite high first thing in the morning, and that's what causes the market to spread like that, and usually that's where the larger money comes from. So I'm going to give it just a second. We're going to watch it and then see it's jumping between $800 and $900 right here. We're going to liquidate that thing as soon as we can, as soon as the bell opens. Let's wait until the bell rings, and then we'll liquidate it and see how much money we make. It's going to be crapshoot here. We'll see where it comes. Right now we're sitting at $900. So let's go make sure that's where that's at. Yeah, 917 is what it's showing. The spread is bouncing all over the place. So we go look at the options chains. This is actually a 2 days. Is it a 2 days? We got to be on the right stock. There we go. 2 days, 0 days. This is 0 days till expiration. And we got a call and a put in here. This is our call. Where's it at? Actually, I think we put them. It's got to be in here somewhere. There it is. So it's green, and you can see the spread on it, 37.50. It keeps jumping all over the place. Open interest is 303, volumes 50 already today. So they're already trading today. What time is it? We got 33 seconds till the bell rings. Let's watch this position and see what happens to it. We're just going to liquidate it as soon as it comes. Bell opens. We're going to see how much of that we can lock in. 20 seconds. We'll lock it in. 20 seconds. And then I'm going to take you over and show you the results of yesterday's trade. The market really ran crazy, and our insurance policy didn't do for us what I had anticipated. But because we're keeping it overnight, it's turning out to be pretty darn good. Pretty darn good. There's the bell. Okay, look at look, it's flushing. Let's see what we can get out of it. Let's go ahead and put an order to liquidate. I'm going to put it in there and say I want $900. When it's profitable and $900. Ooh, it's slow. Come on, go faster. I want to go faster. Now it's down to $800. Now it's at $700. Look at it go down in value. $735, $600. I'd probably just be better. See if we can get out at $800. I just lost $100 just sitting here playing around. Okay, let's see. It says it took it off. Oh, I still got that one open. Let's liquidate that one. I'm just going to mark it out of that one. Okay, so closed. What do we do? $1,600. That doesn't seem right. That says that total gain on that put option. Oh, man, alive. It's flushing like a toilet, that put option. That can't be right. I don't know. That's weird. Went right to zero. So we made the full, it says we made $1,600. That's weird. That's really strange. Gave me the full 1625. I don't know if that's right. That seems weird. It says it's right. It says that's what it did, though. I don't know. It can only do what it says it did. That's what it says it did. Just a little strange. That doesn't seem normal. All right. So there's how we ended up yesterday's iron butterfly anyway. So I guess I'm going to put a question mark by that one. It doesn't seem exactly what I was expecting. All right, let's come in and we'll take a look at yesterday's trade. I want to bring up a chart for you. This is what we did yesterday, and this is why that market went so crazy on us. All right, so that was our cone of probability. We got in and we sold our option right here, and it went up and it rallied and it went outside the cone. It came back into the cone, and we were back into a profitable zone there for a minute, and then it left the zone and it just stayed outside the cone of probability the whole day. I didn't do anything with it. I didn't try to roll it. I didn't try to hedge it. I didn't do anything. I just let it go because I wanted to see what our insurance policy was going to do. Now, I fiddled around. You can see down here, I was goofing off, adding, changing, made a few little small modifications to our strategy where you can see we lost 40, made 50, made a little, nothing serious. It was just kind of taking them off, putting them back on. Land's doing his, newbie thing, being a plebe coming in here and want to put it on like that. And then I changed my mind. Oh, I want to put it on like that. No, I want to try it. Why was this not going in and out the way I wanted to liquidate, put it back on? So I did a couple of those, but that's what you see down there underneath. So that's no big deal. This is the one that's the important one, the top two. So you can see the top two up in there. Let me make that bigger. I don't know if I can blow that up. There we go. So the top two, 975 and 412. So if you take roughly $500. All right. So we made about $500 yesterday on our options, bought call and bought put that we let go. So we lost 975 and we didn't make it. I'm sorry. I'm saying we lost about 500. So we lost 975 on the option on the call that we lost. And then we bought the put, and that made 412. Now, the problem with this strategy is that put spread, and that's what we're trying to deal with right now, right? That's why we have to do more testing, is because that put spread, we should have made as much as we lost. That's the idea, right? That's why you put them right on top of each other. So the lost one pays the same as the win one. And that's the way it's supposed to work. You've got a max loss that you can make, and you got a max profit that you can make. You can only make as much premium as they'll give you. But we had $100 of premium still in there, but that's because the market hadn't gone all the way to expiration. So it's still holding on to $100. That's why when I liquidated, but I still want those to be the same. 975 is, I know you can lose more, but it's the put spread. And that's where the insurance policy is supposed to come in and cover that difference, right? That additional $500. But here's what our insurance policy did. Let me show you that screen. So at the end of the day, you can see right here, the insurance policy was almost perfectly right on top of each other, $1,250. So it did its job but it didn't help us cover. I mean, it covered each other. It covered the loss of one and covered the loss of the other. So we made $637.50 on the call, but we lost $625 on the put. So it didn't do us any good to cover the loss of our long position. See that? So if I bring both those up there at the same time. So this was the ones that we bought right there. These are the ones that we sold. The bots are supposed to be insurance policies to help you pay for the losses of the ones that you sold if one loses. I mean, this one worked out beautifully if the market would have gone straight sideways, right? So that didn't work out as a hedge, is the point that I'm trying to make. It didn't work out as a hedge the way we wanted it to. Although, because I kept it overnight, the next day it actually did, right? Because at this point, this didn't help us hedge this loss right here. So we had a $500 loss, and our insurance policy didn't do it. Don't swear, Lan. You're going to have to go to confession. Didn't do a thing for us. Didn't do a thing. Didn't help us one little bit. Because all it did is covered the losses of its own side, right? So it comes back to the question, did it do its job? Yes, it did its job perfectly. We lost $12, and actually we made a profit of $12.50. That's beautiful. $12.50. That's amazing. But what good was $12.50? It didn't help us cover the loss of our iron butterfly. But what it did do is it helped us reduce the margin. It significantly reduced the margin that we needed to outlay. But so what? I mean, really, so what? Who cares? I mean, reduce the margin. So what? Okay, if you got a small account, that allows you to put the option trade on, which you wouldn't be able to do otherwise. So it reduces the margin amount, allows you to go out and make other trades if that's what you want to do. You go make other trades, or you can put on a larger position. We've just been doing one, right? We could put on 10 because we have our insurance policy that's going to reduce our margin, allows us to put on a much larger quantity if we want to do that. But then in this case, we would have had a much larger loss because it was a losing strategy. Now, I know this is a good strategy. This is a kick bum strategy. Don't swear, Lan. Don't do it. Don't do it. Don't do it. You're going to have to go to confession. I don't want to go to confession. I'm going to try not to go to confession today. Let's see. If we go and pull up our spreadsheet, we know this is a good strategy, isn't it? So this one has a caveat because we were screwing around. We have to go back to May to look at this. These are pretty straightforward. We didn't do a lot of crazy stuff here. I mean, we didn't do any really too weird stuff. And that's a pretty good track record for this wild eye iron butterfly. We only had 2 losers. And we took a loss and we took a loser. Actually, we lost yesterday, didn't we? And the day before. If we go to June, this shows a $2,500 winner, but in reality, we lose. We really only made $50. So it wasn't. I mean, it's still a winner. We made $50 on the actual trade on the iron butterfly. We were testing a bunch of stuff, and so in the put options, we made a whole bunch of money in our test, which is not something we would have done in the real market. If we were really trading, we would not have put all those put options on. We were just doing that as a test. It just so happened that we were testing put options and the market flushed like a toilet. So we made a whole bunch of money in our put options, but they were just testing put options. They weren't something we would have really done. We were just looking at different ones, but we would have made $50. Okay. $50. Hey, green is good as long as it doesn't lose, right? So this is a pretty good track record for the wild eye iron butterfly. We've only lost twice. We lost yesterday. Yesterday was a losing day. The market just ran like a banshee. Let's go look at the market. So this is what let's bring the market back up. So let's kill this. How much did we lose? We got to add it into our spreadsheet. So let me do the math for just 1 second here. Lan, do it in your head. No, I got people watching. I'm not going to try and do math in my head. 975 point minus 412.5, 562.50. So we lost $562.50. So let's go put that into our spreadsheet and write this note for us. Okay, so we're going to come down to June. We're going to come in here and we're going to say that we lost. I want to show up 562. We actually made money because our insurance policy we held overnight made money, 562.5. But we lost money yesterday, and that's how much we lost. And we lost that because this market, look at it flushing. This market went to the moon. And of course, that's that image right there that we put in here. That image right there. That was yesterday's market. Come on, get out of there. How do you get rid of that? You guys, smart people, do you know how to get rid of that stupid thing Microsoft added to their new version of Windows where it drops down and that stupid thing drops down all the time? Like this. Watch. I bring this window up here and it always wants to drop that stupid menu down up there. Oh, now, of course, it's a piece of crap. It doesn't work. Microsoft. It's a worthless thing. I don't know. Maybe you have to touch it. Let's go see. Yeah, there it is. How do you get rid of that dumb thing? I hate that stupid menu up there. If I want that menu, I'll ask for it. Don't force it on me. There's got to be a way. Okay. Anyway, sidetracked. Okay. Land gets sidetracked sometimes. Here we go. This is our cone of probability. So that cone of probability is where the market needs to stay for us to be profitable. And it left it handily yesterday. I mean, it just took off and went to the moon. I thought it was going to come back right in here. And it did for a minute, came right back almost to break even, and then rallied once again going into power hour. So that's what happened yesterday. That's why we lost. That's why the market lost money. And that's been pretty unusual, hasn't it? I mean, we haven't had markets run like that lately. Markets have been pretty quiet. So that's why we lost $562. But we put our insurance policy on for 2 days, and we had our 0 days till expiration, and the insurance policy paid off, didn't it? So the insurance policy, we kept it overnight, and this is where I've got like, what the heck? It's telling us we made $1,625. I don't know how the sold put could be. Oh, wait a second. Oh, that's when we sold the put. So we bought the call and we bought the put. And then when we liquidated them, it says the total gain was 0 on the put that we bought. Oh, well, I guess that's right, isn't it? Because it expired worthless. I mean, it has got no value. Well, we bought it, so it should have had a loss. Should have lost the premium that we paid for it. But I guess it had some profit built into it. It went right back to 0. That's the strange thing. If it would have been like $8.42, I'd be going, oh, okay, that's where it ended up. But it went right to 0. Why would it go right to 0? That's just too uncanny. The chances of that thing to actually go right to 0. Remember, we're in a demo account, so who knows? Who knows what those guys over there in the demo world are doing? This is all the demo stuff. We're practicing. I do these things in real money, and I don't experience that kind of thing in real money. I experience this in demo accounts sometimes, where the accounting is like weird. And then you go do it in the real money account, and everything's cool. But then you get these weird things over here. I don't know. So we're going to say that we made $1,625 because that's what's going into our account. It says we made $1,625. I don't believe it, but I think it was more like $900. I think I'm going to make that adjustment in our account. I don't really want to take $1,625. It just doesn't seem right. So let's put in here that we actually made $900 because that's where I put the limit order and it took it right off. So let's say a $900 profit because we're going to take the assumption that that is a wrong number and it's what it was before we took it off when we were trying to take it off. All right, so we'll do that. So $900 is where I put the limit and it took it right off. So we'll say it was a $900 profit today on that follow through. So we actually made the difference between those two, which is 550. So 6, 7, 8, 9, right? So 6, 7, 8, 9. So we made about $350 yesterday doing what we did. I'm going to say it was about a $350 profit in there. And those two are combined into one day, but they come off in 2 days. So let's make a note of that. So we're going to come in here and we're going to go new note. And we're going to say that this is $900. I don't know what we're going to close out today. 900 days, $900 of profit came from our insurance premium from yesterday's what? Yesterday's Wild Eye Butterfly, where we lost $562.50. I know this is live, so you guys have to watch me type. If it wasn't live, I could edit out all this stuff and you could just see the end result. But you guys are here live, so we got to do it live. This is what we're doing. $900 profit came from our insurance premium from yesterday's Wild Eye Butterfly when we lost $562.50. So I got to put the loss in there. Negative. The market took off like a rocket ship. Is rocket ship one word? Like a rocket ship, it is now. The market took off like a rocket ship, leaving our option strategy in the dust. All right. Okay, I think that's good. We know what that means. And then we got to put in here that this was just the loss, new note on this one, loss of our Wild Eye butterfly. And what we had, I want to make a note on here of what we did yesterday, because what we did, insurance premium was 1 day, right? 1 DTE, 1 day till expiration. And it was our loss of our wild-eye butterfly insurance premium was 1 day till expiration, but it had but it was at the money, right? At the money. So we did the at the money insurance premium with 1 day till expiration. Loss of the wild-eye butterfly insurance premium was 1 day till expiration. The market ran like a banshee. Is that how you spell banshee? Or is it banshee? And so how you spell it today. The market ran like a banshee. So we lost. But our insurance premium, which I held on to until the morning of the following day. Thus, the profit in Wednesday's profit. Thus, the profit in Wednesday's profit column. How's that? Is that well enough documented? There we go. So we got to take a note. Now we got to have a lesson, right? What's the lesson? What did we learn from this? It doesn't do us enough good to just trade. We got to learn something. That's why we're doing it, right? It's all about learning. So what is the note to self today? So the note to self is, what did you learn? What did you learn from this? What we did is we put the option at the money. And so we learned that on the day of the trade, the insurance policy didn't pay off as a hedge. It didn't make enough money. It didn't make enough money to cover the loss of the butterfly. Only the opposing, how do you spell opposing? Opposing order. We still need a hedge for rough days. Or we don't. We can just say, look, we got high enough probability. We're going to win 70%, 75, 80% of the time. We need a hedge for the rough days. We still need a hedge for the rough days. Maybe we don't need a hedge for the rough days. I mean, if we come back and look, that's a pretty damn, oh shit, I just swore. Damn it. That's a pretty damn, now you're going to hear just strings of them come out of my mouth. And now that I got to go to confession anyway, what the hell? Okay, so that's a pretty damn good run right there. Wouldn't you say? Wouldn't you guys say that's a pretty damn good run? Why do we need to worry about hedging to try and save these two? Why? If we're getting this kind of a result from our trade, why do we need to worry about having a hedge on if all we're losing is like that? Well, that's because that month was really solidly dead. The market just didn't go anywhere, which is pretty common for the S&P. I mean, pretty small moving days, but it's pretty stable, which is why we like the S&P, right? The S&P is stable. It's a stable market. Put your money in there. Pretty stable. Doesn't have a lot of ups and downs. I mean, it does on a small time frame, but over a period of time, it just kind of slowly grows, right? That's the idea. That's basically people say the stock market is not the economy. They're only saying that because they're politicians. The stock market is exactly the economy. That's what the stock market is. The stock market is the economy. I mean, it's a representation of the economy. That's why we have GDP, right? Growth, the gross domestic product is how the company grows. And the S&P 500 is a representation of the GDP of our country. So to say that the stock market is not the economy is, I don't know why they say that. I don't know it's got to be a political reason why they would say that. The market's going down. They don't want you to not vote for them. Vote for me anyway, even though the market's going down. That has nothing to do with the economy. The economy is doing great, but the stock market's going down it's tanking. It's going into the toilet. Has nothing to do with the economy. Vote for me anyway. That's what's going on there. The stock market is the economy. That's a representation of the economy. That's what it is. So that's just silliness. All right. So the S&P 500 is a representation of the gross domestic product, right? The 500 largest companies in America. And if the 500 largest companies in America are tanking, well, the economy's not doing well. So it's just beyond me how dumb some people are. I just don't get it. It's all driven by politics, and we all know the world of politics right now is just upside down. Of course, it's been upside down my whole life. I've never had a time in my life where the economy, where the politics haven't been. I've just been kind of like normal. I remember when I was 5 years old, the politics were, you know what? I didn't even think about them. So it must have been normal when I was 5 years old. But was that them or was that me? Politics have always been stupid, crazy, liars. So anyway, that's enough of that. Okay, Lane's getting crazy. We got to go over and do some trading. Let's get off of this politic thing. How am I going to get out of here? Okay. So anyway, back to our conversation. This is a pretty good strategy, right? And we're sitting here worrying about a couple of times where it does this, where we need to hedge it. Because we didn't really hedge it any of these. All we did is just use different insurance policies to bring down the margin, right? So if we think about it like that, then we could say, well, stop trying to hedge it, Land. Stop worrying about it. You're going to lose sometimes. Sometimes you're going to have days where the market takes off and you're going to lose $1,000. But on the days where you don't, and the market just goes and just, you have good trades, you make $1,000, $2,000, and $900, $500. You have good days. You have some good days, a lot of them. So why sit there and bust your hiney trying to hedge, possibly losing a lot of money hedging? I don't know if we lose money. Maybe we make more money hedging if we could get a good hedging system down. That's why, I guess. That's why we sit here and worry about trying to hedge. Make more money. This isn't enough. I want more. That was $11,000 we traded. Every time we did that, we only did quantity 1. We never did quantity 2. Never did quantity 3. These were all quantity 1 trades, every single one of them. And we ended up with $11,000. $11,000 is respectable. How many of you guys make $11,000 a month? And that wasn't even our stock options. We were trading stock options with the profits that we're making from here. And we were day trading over here, goofing off day trading. And we had some pretty bad runs. We had a week of bad runs in day trading. So in day trading, we only made $500. We were trading quantity 1, being really cautious and careful. And that's just the first hour of the day. But, and then I come in. These are some of the afternoon hours. But this is trading in the demo account, not the real money account. And then this is trading with students. So we made another $1,200 there. So what, $2,000? So roughly $2,000 in our day trading. That's what this was. But our wild eye crazy eye made $11,600, and our stock options made $18,900 last month. So overall, for the month of May, we ended up with. Wait a second. That says 18,000. Running profit and loss says 12,000. We made $16,000 on that one. That was because we closed out that great big NVIDIA trade. See, we were sad here. We're like, oh, we closed out some dead wood on that one, 2,500 land. You look really bad there. But that's because we had such big winners. How come that's not showing up there? That should be running profit, 2,000. Why isn't that totaled up properly? Sum H8 to H28, H8 to H28. Oh, it only went to 28. I wonder if that did the same thing. Oh, that one went to 33. 33. That one went all the way down. What about this one? That one went to 30. How come they're all different? This one went to 28 as well. But that one doesn't matter because it didn't have anything below 28. What about that one? That went to only 29, which took into, so it missed this one. These are all wrong. So you guys, if you have this spreadsheet, you need to go in and make these adjustments. Those columns are not totaling up properly. Let's fix that. How do you fix it, Lan? You just come in here and push that little button and drag it up there and say, total the whole thing, you rotten bugger. And then we're going to do the same thing here. We'll hit auto sum on that one and we'll go this direction. See, it's supposed to total both directions and it's supposed to match. And then, why did it just give me that? That was weird. Oh, auto sum this direction, buddy. Okay, going to auto sum this one. Auto sum all the way up there. Auto sum all the way. Do it all. Okay, now that should be, see, there we go. So we made $32,000 last month with our stock options and our futures options. And this is our day trading right here. Day trading, we made $1,500, $1,600, $1,700. $1,700 for a total of $32,000 in 1 month. That's pretty good. Got to admit, pretty good month. January was $1,300. February was $2,000. March, $12,000. Did we start doing our wild eye, crazy eye in March? I think we did. That's where we started doing our March. Started doing our options. This is where we started doing options right here. And then we went into April and we were doing crazy stuff. I think this is where we were trying to develop our strategy and we didn't record anything. Then we did stock options. This is the futures options here. We didn't have a good luck in there. I don't know what we were doing. This is our stock options. We did pretty good, $11,000 in our stock options. And then in May, that's where we kind of perfected our wild eye, crazy eye, iron butterfly. And that's what we did. And then we put money over there in the stock market. We ended up over here. And we don't do the stock market very often because we just don't have time. We only have an hour here in the morning, and this is all 1 hour's worth of trading, right? So that's how we turned out. $32,365 last month. That's pretty good. Not bad. Not bad. How many of you made $32,000 last month at your job? How much is that? How many hours do you work how many hours do you work? Let's bring up a calculator. In 1 month, we have 5, 10, 15, 20. So we have 20 days times 8. So if you work 8 hours a day for 4 weeks, you have 160 hours. 160 hours. So we're going to divide 32,365 by 160 hours. That's $202 an hour at your full-time job. I know there's guys that make that kind of money. $200 an hour. But that's pretty good wages, $200 an hour. Most guys will work, all day for $100 or all day for $200. So, all right. Anyway, just do a little fun math just to see how that turned out. But I think this is a good strategy, and I think it's worth spending more time on, and I think it's worth doing more testing on. And that's what we were doing on our little marquee out front, our little thumbnail, right? Our little thumbnail said that we were going to test this some more. And I wanted to show you some of the things that I was thinking on testing this a little bit more. And if that's that good of a strategy that we're like worried about losing one time or 2 or 3 or 4 or 5 times a month, if we can have that, in 1 month does not make a track record. I mean, it's a track record. It's just not, we got to do it more than just 1 month. But we'll see how we turn out here. So what are we doing? Oh my gosh, look at this market. First of all, we're not going to do it on a market that's doing that. Why in the heck is that market going all over the place? We didn't even look at the news today. Is there some special news? Oh, I think we had non-farm payroll coming up. Was that today? Man alive. Let's bring up the news. Here we go. 8 o'clock. We had what the heck? Employment change at 6745, Global Composite Purchasing Managers Index. Wow, it shot way up. That's uncharacteristic. What the heck happened? Composite rose to 54 and sharply from 51. That's actually good news, isn't it? When the purchasing managers buy a whole bunch of stuff, that's for global services. Global services went way up. Oh, well, it was forecast to be way up. So it was forecast to be 54.4, and it went to 54.5. The previous was 51, so it jumped quite significantly. Purchasing Managers Index, that's the stuff that all the buyers are buying. So they're buying stuff, and usually it's factories, right? So they're buying stuff so they can manufacture and make stuff because they have a need for it. So that's good. And in ISM Services PMI, Purchasing Managers, oh, wait a second. Non-manufacturing went way down. Well, it went up. It was forecast to be 51, and it was at 53, and the previous was 49, so that's actually good. The non-services purchase PMI went up at 8 o'clock. That's what's going on right now. The market should rally back up. It's going all over the place. Don't want to put on a wild eye, crazy eye right now. That's for sure. Crude oil is coming out at 8:30. We could go look at the crude oil market at 8:30. It's always fun to trade. Well, it's sitting right back dead center of our VWAP. It's right at VWAP right now. Look at that. The S&P is sitting right flat at VWAP. You want to put on your wild eye, crazy eye? Probably not. I don't know. It might just die. Just go dead, be dead all day, and we'll wish we would have put it on, right? So yesterday, we made a bunch of money because we put it on. Now, what did I do yesterday? Now, I want to show you the difference of what I did yesterday, just for fun. I mean, I was trying something different. I was like, what if we looked at this from a different point of view? And what I did, let's go do it a couple of times. It's a demo account. We don't care. We play. That's what we do here. So I come in here to the options chain, and this is my thought process. This is why I went in and out several times after I'd closed out the class, and you guys didn't see me do any of this. So the idea was I did a 1 day, and let me show you what I did first. So this is what we did. We came in here and we said, okay, we're going to buy a call, and we're going to buy a put. All right, that's our insurance policy. We have to put that on first because if we do sold and we're not doing them on the same ticket, we have to cover ourselves. So we have to do the bots first. You can't do the solds first. You have to do the bots first. So we're going to come in here, and I'm just going to market into these. We're going to go in. Okay, so we're in the market. We have our bots. That's our insurance policies, and we did those right on top of each other, and we did 1 day. We kept them overnight. The market ran like crazy, so that's why we made a bunch of money yesterday, $900. But we also sold the options. So we come in here, and I sold 0 days till expiration. And I did this on a separate ticket. So I come in here, and I sold this one, and I sold this one. And then I just market into that one. And we got the same thing, too. So we got that's our iron butterfly, right? Our wild eye butterfly. Calendar butterfly is what it is. So we sold. See how they're on 2 separate tickets. And I like to do that because I like to come in, and on the sold ones, I like to come in and say, okay, I'm going to sell these, but I don't want to sell these. I want to keep the insurance policies because, first of all, we might want to put another one on, right? Take it off at 25%. And then we might want to put another one on. And so we don't want to sell the insurance policy out. We just keep the insurance policy and put another one on. But the thing is, the question about that is, why would we, if we're going to reset the delta cone of probability, why don't we sell out the insurance policies too and reset those? We have to pay a commission, and we have to pay the spread. So that's not a set in stone thing. That's not something that we have to do. We don't have to just, we could definitely sell and liquidate the insurance policies to reset them to the center of the delta cone. If the delta cone, and the only reason we would reset the 0 days till expiration at 25% is if we're outside the delta cone, right? Or if we're close to it and looks like it's going to leave the delta cone. We would liquidate it, take our profits, 25%, and then reset it, sell it again at the delta cone. Well, if that's the case, our insurance policy wouldn't be outside the delta cone. It'd be inside the delta cone. But that's only because we're doing them at the money. When we were talking about doing 25%, taking them off at 25%, and not selling the delta cone, not selling the insurance policies, That was because we were doing them at a delta of 20, right? We were putting the wings way out there, a long ways away. And so they didn't really have a lot of effect on the market itself, taking the zero at the money options off at, I'm just thinking out loud here. Go with me on this. That's why we weren't taking the insurance policies off, because we weren't resetting them because they were out at the delta 20. So they were worthless. The only reason we were even using them was to just reduce the margin. And they were doing that, right? They reduced the margin for us a little bit, but they never gave us any hedging capabilities at all. But we noticed, we just, like yesterday, the hedging, when we close that thing out, right? Think about that. At the end of the day, here's the slide again. At the end of the day, that thing was dead on worthless anyway. Now, it made money because we kept it the next day, and it had a profit. It came out profitable the next day, right? If the numbers were correct in the demo account. But that's how they were sitting at the end of the day yesterday. Or not quite the end, but pretty close. Close of the New York stock market. So that's how they were ending at the end of the day yesterday. So I'm trying to just formulate in my head what we're doing here and what would be best. And I don't know if there's any one best answer. Trying to get to that one best answer. What's better, Lance? Should we do it like this or should we do it like that? I don't know. It depends on what the market does. And the market's different every day. Sometimes it'd be better to do it this way, and sometimes it'd be better to do it that way. How do you know? Well, more often, what does it do? Well, more often the market doesn't move. It's rare that it does this, right? I mean, more often than not, the market doesn't move. Now, we learned the other day about the skew and about the VIX. And the VIX tells us when the market has a lot of volatility. And we don't want to really put this strategy on when the market has a lot of volatility, because when it has a lot of volatility, that's when you lose money. Of course, if you got a nice strategy of insurance policy, so there we go. Let's think about it like this. If you got a nice strategy for an insurance policy where the market really takes off and runs, if you do the at the monies, you're more likely to pay off the next day if you keep it overnight than if you had the big delta 20s. If you did the far out delta 20s, they don't cost you very much. This didn't cost us anything. I mean, $12.50. But yet the next day, because the market did take off, it paid off $900. Those 20 delta 20s, they would never made us $900. They'd probably not made anything. Well, I guess they'd made a little bit. Actually, take that back. They might have made more. Because when you take a big risk, which is a delta 20 is a big risk, is you're not going to pay off, right? If you got a delta 20, that's like a 20% chance that market's going to make money. So if it does pay off, it pays off with a large percentage, huge percentage. It's usually not as big a dollar amount, but it's a huge percentage, because you only put up, when you buy a delta 20 option, it only costs what? Let's go look at one right now. Let's go see what one costs. We go in here and we look at a delta 20 option. Delta 16. All we got, well, is this the S&P? Okay, all we got is 16 days. This contract must be coming. This is June contract. It's coming to an end. We got 16 days. So a 16-day delta 20. Let's go look and see what a delta 20 call would cost. $500. So the percent increase, so 20% of $500. Well, that's probabilities. Let's see, where's our percent? Well, it's not going to show it to us in here, is it? Okay, so you're going to pay $500, and you're going to make let's say we make 100%. All right. Well, 100% of $500 is $500. But if you make 100% of the at the money, which was $2,700, it's still 100%. You made 100%. But 100% of $2,737 is a lot more dollar amount than 100% of $500, right? And that's usually how it runs. Now, sometimes the market will run like that, and those really far out of the money options will make a larger percentage, but not a tremendously large amount of percentage larger, just a larger percentage. So where, let's say 100%, it might be 135, 150%. So still, even at 150%, let's say even 200%. Let's say that the Delta 20 makes 200%. Because it's like buying a lotto ticket, right? That's what we call those. We call them lotto tickets because the chances of them paying off, that's why it's a Delta 20. The probability is roughly you got 20% chance that it's going to pay off. Why? Because it's sitting on the outside of that cone of probability. Now, I updated this sheet for you guys. If you want to go get the new version, I've got some other stuff in here. I worked on it a little bit yesterday. So you know how to get it. Here, I'll show you. Take your little scanner, scan that, go to pitnews.com, hit store.com. This sheet right here is free. I just give it away. All right. And I added some new stuff to it, reorganized some stuff, fixed some spelling errors, stuff like that. But we know that we have our cone of probability, right? I've showed it to you a million times. Let's bring it up here one more time, just for those guys who are new. And if there's anybody new, I hope you're sticking around. I know we're not trading very much. We're surmising. For those guys who have been here for a while, this is a long time conversation of what we've been doing. And we're trying to, come to some conclusions on what we should do here and why we're doing what we're doing. So it's just kind of a brainstorming session right now. So Michael Bruce. I'm looking at some of the comments in here. Michael Bruce is like, your spreadsheet's always been screwed up, Lan. So sorry. I hope I fixed it. There's probably more errors in it. I'm not the greatest spreadsheet guy. As you can tell, it takes me a long time to figure out even how to do a little red and green check mark. I spent a whole day just trying to make those little red and green check marks. So I'm not the best spreadsheet guy. But I spent a lot of time on it to give it to you guys for free. If you subscribe to Pit News Magazine, you can have it. All right. And this is just free for coming and showing up. Just come show up with me and you can have these slides. But this is our cone of probability. Or this is not our cone of probability. This is our theta. Our theta decay. This is where's our cone of probability? There's that one. Where's the other one? Yeah, it's probably up here somewhere. I don't know what I did with it. I'm trying to reorganize things, so I move stuff around, and then I move them around, and I don't remember where I put them. Well, it makes sense. It's more logical to be down here, Lan. Okay, then I move it, and then I don't know where it is. Oh, there it is. That's the one. So you can see the reason it's way out here in the 99.7% data fails. Remember, this is our empirical data distribution rule. And so what it's saying is that the market is way out here on the ends, and that's where we're buying those Delta 20s, right? Clear out here on the 1, 2 standard deviation, 3 standard deviation outside of the cone of probability. So there is that. So where was I going with that logic? If you make 200%, way out on the cone of 2 standard, 3 standard deviations away from the cone of probability, you can make a larger percent. Even if it's 200% of $500, that's still only 100 and what? It's 500 times 2. So you're in the $1,500. There you make $1,000 on a $500 investment, right? So if you make 100%, you got 500, and you 100%, you make 500. You make 200%, you'd make 1,000. But if you make 200%, even that, you're still down here at the money. You got $2,700 that you put in, and you make 100%, not 200%. You're still more money. The dollar amount is larger. The percent is not larger, but the dollar amount is. But the problem with that is it's irrelevant, right? Because the other side is losing the same amount. Okay, so if you're losing the same amount as you're making, which is better, a larger percent, or should it come out to be the same? Discounting the option skew, the put skew. We're going to discount the put skew and pretend like they're exactly the same. Let's say it's $100 up here and it's $100 down here. This one makes 200%. Well, it's going to lose. Is it going to lose 200%? No. Why? Because it's got a max loss. It can only lose the premium you paid for it. So if the premium loses 200%, well, it's going to lose only $500, but it's going to make 200% up here. But that's only if you made 200%. Chances of it making losing 100% is pretty rare. Not that it doesn't happen. It does in options. But it would have to make 100% for it to get beyond the losses zone so that the 20% probability, then it just comes back out to the chances of that happening. The probabilities of that happening are so low. It's like 99.7% of the time it's not going to do that. So why are you worried about it? Why are you sitting there fretting over the 99.7%? Worry about the 68.2%. That's what it's going to do most of the time. 68.2% is going to stay inside that cone of probability. Okay, well, if it stays inside that cone of probability, how do I maximize my profit there? So when it does leave that 99.7% or 95.4% time that we lose money, right, that we don't lose money, it stays inside at 94.4%. So we're saying 5% of the time we're going to lose money at this level, and less than 1% of the time we're going to lose money at this level. And saying right here, 68% of the time we're going to make money. So we're going to make money 68.2% of the time. And that proves out to be pretty darn accurate with our experience, right? With our spreadsheet here. I mean, if we were to come back and measure, this is actually better percentage than 62%. We've been with 68, 70. Well, that's probably pretty close. So this says about 68.2. So almost 70% of the time it says you're going to make money if you bet on making money inside the cone of probability, inside the first standard deviation. So you're going to say, okay, 68.2% of the time, the market's going to stay inside the one standard deviation. Therefore, that's where I want to focus my energy and my concentration. What's going on out here at 90.7 and 95.4, I don't really care. Why do I care? Well, you care because those are nasty losses when it does go out there. They can be nasty losses. Yeah, but they're nasty wins when you're in here. So you have a lot more nasty wins and you have a few nasty losses. They're pretty good nasty wins, right? Those are pretty good wins. And our losses when it did go outside the cone of probability were here. So it all comes down to where do we want to put our insurance policy? And I'm trying to figure that out. I'm trying to brainstorm it. What do you guys think? Where should we put our insurance policy? Should we put it at the money or way out on the Delta 20s? It seems to me with all of this rhetoric and logic that we've been talking about, we should focus and concentrate on just putting our insurance policy at the money, the same place that we're putting our sold options to be where we put our call options, and not put them way out there at the Delta 20s. Focus on the 68.2 land. Focus on the 68.2. Don't worry about the 95.4. Don't worry about the 99.7. Where do you make the most money? We make the most money within the 68.2. We make all the money right in here. So why don't you use an insurance policy that's going to make you more money inside that cone and less money out here? And not worry about the 99. Because if you worry about making money inside the one standard deviation, it's going to automatically cover the outside. It's going to cover these automatically. It's the same amount of money. I mean, you have to put more money up front, right? Bruce says he's having his experience is saying that he's doing better at the money as well. Got to drink some tea. Hold on. Sorry about that. I was pontificating without the microphone on. Maybe that was actually better. You didn't have to hear me. Okay, so the idea, the theory was, the question was, would it be cheaper for the insurance policy? The insurance policy on the outer wings are half the price, right? If not more. So they're half the price. $500. Sorry, guys. I need to remember when I drink tea and I don't want to make any noises. Turn the microphone off. I got to leave my hand on the mic so I don't turn it off. I got this new thing for the microphone. It's a great big thing. And hopefully it stops so much of the pops. It's having popping problems. All right. So been trying not to do so many popping problems with the microphone. So that's the question. The question is, which is more expensive? Well, it costs more to put it on, but it makes more when it's wrong, right? So is it really more expensive? It's actually less expensive because you actually make more money. Like today, we made $1,000 on it because we kept it on overnight. We kept the insurance policy on overnight. Well, you could have kept the insurance policy on overnight of the Delta 20s. Yes. And the market ran. Yes. Your percentage probably would have been a larger percentage. And that goes back to that percentage question we were having. The percentage of 500, even if you get a 100% increase, 100% increase on a $500 amount of money is $500. But a 100% increase on a $2,000 increase is $2,000. So the percentage is the same, but the dollar amount is larger, and you didn't take any more risk. In fact, I think that by doing it at the money, you're actually taking less risk because they're more likely to pay off, make money. I think that's our answer right there. And I think Bruce is saying the same thing. If we put them at the money, it costs us more up front, but it actually costs us less in the long run because we actually have the potential of making money more often because we'd be making money, right? Again, back to our cone of probability. If we do them at the money, focus on the 95.4%, focus on the 68.2%, focus on the one standard deviation. By putting our insurance policies out into the 2 or 3 standard deviation, even if we made more money beyond the percent, the likelihood of us making that money is all the way down to 95, is 5%, 1% of the time. We're not going to make it. We might make more money 1% of the time or 5% of the time. We make less money 68% of the time. But when we make money on 68% of the time, we make good money. I think that's the answer. I think we're doing it right. I think just putting them at the money is the answer. Now, let me show you what I was doing yesterday. This is where I got to what I was doing, where I was screwing around yesterday. So this is how I started out. And this is what the position looked like. Look at that. It's exactly on top of each other. So it's working. What we want is we just want the time decay, right? What's not working is the put call spread. The put call, see, we're off by that's what I was trying to solve right there, is that $87 loss right here. Now we're making 75 here, losing 75 here. But the coverage here is 145 profit and we're 200 loss. 75 profit, 75 loss, 125 profit. I really want those to be as close to each other as possible. I don't know if you can do it. I don't know if that's possible. And the way I was trying to do that is by separating the order so they're not right on top of each other and trying to give one order more credence than the other. And what that does is that pushes your insurance policies apart. So we would actually skew to the put side to try and get a higher return on the put or higher return on the call to match the put. Because see, I don't want this right here to be down a difference of these should be exactly the same. I should be making as much money on the call as I'm losing on the put, but I'm not. My call's only making 112, my put's losing 187. So how do I make it so the call makes 187 if the put's losing 187? That's what I was playing with yesterday. And that's why we were trying to put the skew out. And so we would try to make it so we put the call in the money a little bit farther so that when it makes money, it has a larger delta, right? So if it has a larger delta, it's going to make more money. And that's where I was talking about yesterday, where I was saying, hey, mate, wait a second. I think the clue here is that we need to not just be buying them at the money. We need to buy them at the same delta. So if we come in and we look at the, let's look at both of them at the same time. So I'm going to clear this. Let's go ahead and we'll take this off. This is the way we've been doing it. I'm just trying to figure out a better way to put them on. I think we're going to still stick to the money, but now we can skew them a little bit. So that's what I was trying to do yesterday. So I'm going to exit. Let's exit all options. Exit chart. Yes. Okay. So we got those off. And now what I want to do is I want to put them back on. So I want to put on the insurance policies. We got to do them first. But I want to do them at the same delta. I want to buy a put and a call at the same delta. Now they're jumping around. That's a problem, is because they're always jumping around. So if I wanted to buy the put, I want to actually buy the call in the money a little bit. So if I'm going to sell this one, or if I'm going to buy this put, right? So I'm going to buy the put. So that's the traditional. That's one we're going to buy. That's at a delta of 46. So that means I need to have a delta of 46 on the call. The call, delta 40. Well, I can't get a delta 46. Oh, no. I would have to go out of it. I don't want that. I put, the delta's not, the delta's already higher on the call. It's at 5.4. And that wasn't enough. Was it? What if we go in and we put a delta? See, if we bought that delta call, it's got a delta of 55. This one's got a delta of 46. So we buy that put with a delta of 46. That means I have to have a delta of at least 46. But I got right at the money, I have a delta of 55. Well, let's increase the delta higher. Let's come in here and put this delta at 59. We go two. If we bought that one, we'd have a higher delta. I don't know if we need to go 2 deltas higher. We could go 1 delta higher, or one strike higher instead of 2. But we might exaggerate it by going to 2. But look at how much more money it is. It's $400 more money. All right. So let's mark it into that one for fun. Just watch that for a second. Now we're going to come in. And what about the sold ones? Do we want to do the same skew on the sold ones? I don't know. Is those zeros or ones? Oh, I did those on 16s. No wonders that felt weird. So that was an error on my part. So we're going to do, let's do 1 day. We'll just do 1 day. Here we got it. Okay, now we can do this. So we want to buy this one. And again, we're going to come down here with a delta. Do we need 2? Let's do 2. Okay, so we're going to buy that one. All right, so we bought the put and we bought the call. We bought the in the money call. Now we got to go put our insurance. Now we got to go do the same thing with the 0 days till expiration. And this one we're going to sell. So we're going to sell a 55. But to get the premium on the put, there's 54 right there. I only went 1 out. I got the same delta. 53 and 55. That's pretty close. Maybe I should have delta skewed it just for fun, just to see what that would do. Let's roll this one. We're going to roll it up, and we're going to roll it up 1 strike. 53.35. So I just rolled that up. Is all I did. So now it's out here. So we sold that one. Okay, so now we're going to watch it. Oh, now they're not on the same ticket. Damn it. Oh, well. So now the skew on this look at that. The top one is exactly the same. 62. 62.50. It's bouncing a little. The buy call is actually keeping up with the loss on the put. We need it to move a little bit farther to see that play out. So this is what we were talking about yesterday. Michael Bruce says, Lan, you're missing your day trade opportunity. The S&P is going to the moon too. So look at the skew on that. We're keeping right on top of each other. And we bought these as separate. That's a lot better, isn't it? Look at that. We did it too. How about that? Now the solds aren't doing as well. We sold the call and we sold the put with the same deltas. Look at the delta skew on this one. We're making $100 and we're losing $100. That was what I was really wanting to see right there. These two both have a delta of 0.58. And see that? I'm losing 75 and I'm making 37. That, boom, right there. Whoa, my chair just about fell over. So we skewed the delta on the call and the put by 2. Well, we did the same with the sold, didn't we? We're not on top of each other with the sold. We're 2. How come we're not getting the same skew on the sold? Oh, wait a second. We bought ones and we sold zeros. How come we're not getting the same loss cross? How come we're not getting the same cross with the ones we sold? Did I do it backwards? Sell a put and sell the call. The bought ones are right on top of each other. Oh no, we sold a call at 53.25 and we bought a put at 53.25. We sold a put which is in the money. Oh, did we go the wrong way? No. Yes. I think we did it wrong. I think we did it backwards. I think we did the buys right, but I think the sells I did wrong. Because I sold that put in the money for $662. And the one that's covering it is the buy put. And it's losing money. Oh, it's coming back to be pretty close. Maybe that's right. Now, the other thing I did yesterday is I put them on, because I've been putting them on same tickets. The buy call and the buys, and the 2 buys have been on one ticket and the 2 sells are on one ticket. And then I started thinking, well, if we're not going to liquidate them, if we're not going to do the 25% change, why do we put them on separate tickets like this? We should put them on separate tickets so the buy and the call is just, so the ones that cover each other are the same. So I'm going to write that down, because if we're going to, we would put the buy one day on a ticket along with the sell of a 0 days all on the same ticket. That way you would see the one that's covering it right? You'd see the one that was covering it. I don't know if I can articulate what I'm saying. Okay, let's think about it another way. Let's think about this a different way. We're going to come in here. We're going to liquidate all these because I think this is right. I think we should do a put skew. We're going to have to test this, right? Theoretically, it's the right thing to do. I think it's the right thing to do. Theoretically. Okay, let's exit this. And let's think about putting it on again. Only this time we're going to put them on so they cover each other. So we're going to put on a 0 DTEs and a 1 day DTE. So we're going to do 1 day DTE, and we're going to, this is our insurance policy, and we're going to cover the loss. Can we do that? No, because we still need to know the deltas of the, how are we going to put this on so that we know, so we can do the delta skew and also have them on separate tickets. Let's just try it. It's best just jump in there and do it and see if we might have to do it 2 or 3 times to figure out what we're trying to do here. So I've been doing this for a long time, and sometimes in my brain it gets a little complicated. So if you guys feel a little overwhelmed and complicated when you're trying to figure out some of these option strategies, just know it's normal. Don't feel like, oh, I can't do this. It's hard. Yeah, it's hard. If it wasn't hard, everybody'd be doing it. I've been doing this a long time, and I'm racking my brain to try and figure out how to do some of this stuff. It takes a little bit. You have to think through it. You don't make $200 an hour doing something that's easy. Okay, let's think about this. We're going to come in here and we want to sell the at the money. So we're going to sell this one. So the first leg, we're going to sell that one. And I want to put the bought on the same ticket. Oh, that's a 1. We got to go to zeros first. 0 first. And we're going to, if I sell a call, I have to buy a put. Now, if I sell a call, if I buy a call, I want the market to go up. If I sell a call, I want the market to go down. But if I sell a call and the market goes up, I need protection. So I need a long call. So I need to put 2 calls on one, and I need to put 2 puts on one. Right? Yeah. Put the 2 that are protecting each other on the same ticket. So now I'm going to come in and I'm going to do a put skew. So I'm going to buy a call in the money. So that would have to be down here. And it would have to be a 1 day. And if I did that, I wouldn't even have to be 1 day. I could do 0 days. But then that's going to cost me more. Now I lost my 53.30. So 53.30 is where I sold it. So I'm going to buy it at 53.25 in the money. Right? I could probably do it easier with drag and drop. So if I sold this one and I bought this one in the money, that would protect me to the upside if this thing failed, if the market went up. But the market's going down. So I would actually lose more money on the call that I would lose more money on this one than I'd make on that one. So that's the idea, because my other insurance policy is going to be in the opposite direction. See, this is where I'm getting screwed up. Let's put this on. Now what that does, that puts that on the same ticket, see? So now I can see how my long call is protecting my short call. So my long call is protecting my short call. So if the market falls, the long call, which is 1 day till expiration, is going to lose money. But it's not going to lose money as fast as the 0 days till expiration sold call is going to make money. You would think. The sold call if the market falls, should make money quicker than the 1 day till expiration bought call. Loses money. Now, if we want to do that in the opposite direction with the puts, we'd have to do just the opposite, put in on the other ticket. And then we try to do the put skew. It's getting complicated. So now we're going to come in here and we're going to do puts only. Let's drag and drop it. That might be easier. So we're going to sell at the same price. We're going to sell the put at the same price as we bought that one. And we're going to buy a put in the money. Right? Okay, so now in our positions, see what we've done? We put the calls on one ticket and we put the puts on one ticket. What we've always done in the past is we put the call and put on a ticket, the bought call and put on a ticket, and the sold call on a ticket. Here I've done just the opposite, and I've also added the put skew. So I put the calls on one ticket, I put the puts on one ticket, and I did the skew. So the solds are still at the money, but the insurance premiums are both pushed not at the money and not out of the money. I've pushed them in the money, and I put them on separate tickets. See what I've done? So now the insurance policy should actually pay off better if the market moves, and they should cover the put skew. Now I only did one, and in our previous example we did two, didn't we? We did 2 strikes. Are you guys following me? We did 2 strikes out. This one I only did 1 strike out. I could put on another one and we could compare the 1 strikeout to the 2 strikes out, but it starts getting so complicated. Then we start, I'm not sure I can keep them. Start getting confused. It's better to just do them one at a time. I don't know. I could put them on again. I would need to put on another one here and then push the other ones, the wings, or we could just put the wings out there and realize that, hey, we're not going to be doing both wings. We'll have to do them. We just decide which one was better, this wing or this wing. So we could come in here, and that means we would buy a call out here and we would buy a put out here, right? Yeah. So which one of those is going to be better? And we didn't do them at the same time, so. Oh, that's not what I wanted to do, because the insurance policies are supposed to be, let's clear that. Okay, liquidate that one. We want those to be 1 day. That was 0, 1 day. So we're going to buy the call out here, and we're going to buy the put out here. Those are in the money. Oh, wait, that's backwards. We want to buy the put in the money, buy the call in the money. Am I doing it right this time? All right, I think so. All right, I think that's what we're doing. Okay, now we just have to let it play out for a few hours and see how it turns out. Okay, let's take a picture of this. And take these and throw those into our research folder. Take a new picture. Okay, I've snapped that for us so tomorrow we can remember what we did. Desktop. Okay. All right, so I snapped a picture of what we did. Sometimes I do all this logic. I sit here and think and I brainstorm and I go through all this stuff and I come to conclusions and then the next day I forget what I even did. I'm like, I don't even know what I was talking about. I have to learn the same thing all over again 2 or 3 times. That's just my brain. I just sometimes get so scatterbrained with all this stuff. Michael Bruce says he thinks he's better off as an options trader than a day trader. Well, both are fun. It depends on whether you're doing it for money or fun. You doing it for money or fun? Yesterday, was it yesterday or the day before yesterday? I didn't trade real money yesterday in the futures market. I only trade the stock market yesterday with real money. Yesterday, but the day before, remember I did the real money trade. I had to day trade myself out of a really bad situation. So my option ended up losing a whole bunch of money and I had to day trade myself back to break even. I had to day trade and make, I think I ended up at the end of the day, I had to make close to $600 day trading to bring myself back to break even on my hedge of my wild eye, crazy eye. So when the option went haywire, I needed those day trading skills to save myself. So to say myopically, well, I'm only going to be an options trader, you're leaving half the money on the table where you could have possibly saved yourself had you had the skills to day trade yourself out of it. Whether you want to do that or not, I don't know. If you're not a good enough day trader to do it, you're probably better off not day trading and just doing the options and letting them run and not try to hedge them. Because sometimes you can hedge, sit there and day trade hedge and end up losing more money than what you would have lost just having the options. But if you're confident in your day trading skills, then you can do a little bit of day trading to try and hedge and get your lost options back in play. Does that make sense? Not that just being an options trader isn't a good idea. It is. I mean, just do that. There's nothing wrong with that. I'm just saying that sometimes to save yourself, being a good day trader can give you that little extra edge. So keep those skills up. You might need them once in a while. But if we focus, kind of focus a lot of our attention, and we know on the day trading too, we day trade every day in here when we come in and we goof off and we try to make money every single day. And it's not always a good day to day trade. It's not always a good setup. Sometimes we do things in the demo account, obviously in the demo account, but sometimes we do things on YouTube. I call it financial entertainment, right? I mean, you guys come here and want to be entertained. Entertain me, land. So I have to trade. I feel pressured to trade just to entertain. And so oftentimes that's the wrong thing to do. And that teaches bad habits because you're watching Land do it. And it's like, oh, Land did that. Well, Land was entertaining that day. He wasn't really trading for profit. He was in a demo account. Keep that in mind. And so there's a lot of that that goes on YouTube, right? And when I'm alone, I don't trade like that. I'm very cautious, very careful. And I wait for the right setups and triggers. And sometimes I'll wait for 2 or 3 hours to put on one trade. And then once the market starts to move, then I get active and I'm trading, right? For that moment while it's doing that. But to come to the YouTube and say, well, that's how you trade, that's not really fair assessment of day trading either, because I do a lot of things differently in my real money accounts than I do in the financial entertainment world. So keep that in mind too. Just take everything we do with a grain of salt. Mostly what we're trying to do is learn here. And then we take what we learn here over into the real markets. And one thing I hope we learn is to not overtrade. Overtrading is the death of a trader. But not trading enough, well, that's how you don't make money too, right? You got to trade. You got to be okay with pulling the trigger and realizing that, hey, sometimes I'm going to pull the trigger and I'm not going to make money. But you can't make money if you don't pull the trigger. So there's that side of it too. You have to trade. You have to be willing to pull the trigger. That's why you need to be smart about it. Cut your losers short, let your winners run. That's not just a cute saying. The market doesn't immediately go in your favor when you're day trading. If I can't teach you anything else, if you come to this class for 2 solid years and you don't learn anything other than one thing, if that market does not immediately go in your favor when you get in, just get out, because it'll go immediately in your favor often enough that you don't need to wait for a big drawdown for it to turn around and come back. Just wait for a good setup, wait for a good trigger, put your order in there, and if it just doesn't immediately go in your favor, just get out. There's no reason to stay in a market that's not immediately going parabolic in your favor. Just don't do it. If I would have learned that 25 years ago, I would be in a whole different place, because I took big losses all the time. I put my stop way back where, behind the biggest area of support. Oh, you want to get in right here, Lan? Okay, let's get in right here. Okay, I'm going to get in right here. So I put my order in, I get in right there. Well, where are you going to put your stop? Well, I'm going to put my stop back behind the area of support. Where's that? Down here. Oh, so your stop's down there? Yeah. Okay, well, how much money is that? Well, that's from here to here. That's $950. But that's where my stop goes. I'm just going to wait until I lose $950 or until it goes to the moon. Well, it only has to hit your $950 once or twice, and then you're like, oh, how do I recover that? Right? Don't do that. Don't do that. If it's not just going to go immediately in your favor from where you get in, why would you sit through a big, nasty drawdown hoping that it comes back? Now you have to not only make the $950 down, you lose $1,000 down. Now you have to make $1,000 to get back. And it's hard to make $1,000. And now you have to make $1,000 just to get back to break even. That's what this little chart here is all about. Look at this. Let me show you one more chart before we sign off. This will be your Sunday school lesson. Gains needed to recover a loss. If you lose 1%, you need to gain 1%. If you lose 5%, you need to gain 5%. If you lose 400%, you need to gain 400%. If you have $100 and you lose $50, you need to make $50 back to become whole, which is 100% of the new starting balance of $50. See that? If you lose this much, you have to make this much just to get back to break even. Think about that for a minute. If you have $100 and you lose $50, now all you have is $50. You need to make $50 back just to get back to whole. That's 100%. Just to get back to your starting point, you have to make 100%. Making 100% is hard. That's why we say cut your losers short, let your winners run. If it doesn't immediately go in your favor, just get out, because you don't want to have to recover $1,000 on this one. This is a land. This is a 2-minute chart. Put your stop back behind the area of support. Okay, that's $1,000 back in this example. Do I want to lose $1,000? Because then I have to make $1,000 just to get back to break even, and I don't even have the full amount. I have $1,000 less to do it with. So again, if you come to this class for 2 years, you don't learn anything. Cut your losers short, let your winners run. And it's not just a cute saying. It's the thing I said in the very first class that you ever took from me. Cut your losers short, let your winners run. And putting your stop way back here, $1,000, that's not cutting your losers short. That's letting your losers run. All right, guys, that's my Sunday school lesson for today. And we're going to let this run. We're going to see how it goes. I've got two sets of insurance policies down here. Don't I? Or did I screw up again? I put these outside. Okay, we're just going to compare these. These are not compared against each other. These are replacing the two bot options inside of the other two. We got to remember that. Okay. This one here is this one better, the bot call, better than this bot call? Or is this bot put better than this bot put? That's what we're really comparing. We're not comparing these two against each other. Keep that in mind. All right, guys, I'm going to let this run, and we'll come back and we'll talk about it tomorrow, and I'll show you what happened. We'll see what the results were from all of our brainstorming today. This was a tough class. This was a hard class. Lots of deep thought. Lots of trying to surmise different things. All right, if you like this class, give me a thumbs up, because if you don't give me a thumbs up, I won't do this again. We'll just go out and we'll just dink around day trading. Oh, buy, sell, buy, sell, buy, sell, buy, sell. on the wrestle. If that's what you like to do, that's what we'll do. But if you like this kind of thing, I need to know. I've lost my voice. See you guys tomorrow.